Hello everyone and welcome to the monthly market update. I'm John Cunnison, I'm the Chief Investment Officer at Baker Boyer Bank. I'm going to start with stock market returns, which have been really quite good year to date. So for the first quarter of this year, US stocks are up just over 9%. International stocks also doing quite well, close to 5%. So it's been a good year for the US markets. In this chart, what you can see on the far left-hand side, back at the end of 2021 was a previous all-time high for the S&P 500. And then of course we had a bout of inflation. Federal Reserve in 2022 began aggressively increasing interest rates, which caused investors to think that the economy could slow. Stocks sold off as a result. So we had a 2-year period where we did not regain that record high that we saw at the end of 2021 until very recently. So this year, we've seen 22 all-time record highs that are illustrated in this chart in those yellow dots on the right-hand side. So a good year so far in markets. Now, this may raise the question, where do we find value in today's market? And this chart attempts to provide a little bit of light on that question. So basically, this chart shows where different sectors of the market, and this chart shows 20 different economic sectors, so different ways to slice and dice the market. And basically, if a sector is in the upper right corner of this chart, it's relatively expensive, both compared to the market and to its own history. In the lower left corner of this chart, these are areas of the stock market that are relatively inexpensive compared to the broad market and their own history. And other sectors that you see that are not in those two areas, most of them in the upper left corner, are somewhere in between. One thing we can take from this is that right now, technology stocks do appear to be relatively expensive. And this is drawing a lot of comparisons to the dot-com era. So the last time that we saw technology stocks at fairly high valuations, fairly expensive, and having really incredible returns. Now there's some really important differences that I want to point out between the dot-com era and today. On the left-hand side, this shows earnings growth trends between technology stocks, or the technology sector of the US stock market, in the dark blue line, and it shows the rest of the S&P 500, or the broad S&P 500 in the dotted blue line. Now what we can see here is not only do technology stocks, not only are they profitable currently, but they're also growing their profits, growing earnings more quickly than the broad stock market. Now this is a marked difference from what we saw during the dot-com bubble and bust, where many of these companies in the dot-com bubble were not profitable. On the right-hand side of this chart, you can see some of just the fundamentals. So in the light blue, this is the dot-com fundamentals. So, and what we see is when it says 55x, that means that back during the dot-com bubble, you paid $55 for $1 of a company's expected earnings. Today, you pay just $28, and this is looking at all technology sector stocks. So today, those tech stocks are less expensive and their profit margins are higher, and that's what we see on the right side. I'm not suggesting here that technology stocks are cheap and you should go out and buy them, but I am suggesting that maybe now is not a time to run from them like we might have suggested during the dot-com era. So it's a time to maintain our exposure. Now, while stocks have traded higher in 2024, bond prices have declined. So the broad bond market in the United States, which looks at all investment grade bonds, is down about 1% so far this year. So why have bonds traded lower? Well, the answer is that investors expect fewer rate cuts this year than they did just 6 months ago. This slide shows the differences in the market's expectation for where interest rates are going and the Federal Reserve's expectations for where interest rates are going by the end of 2024. So the blue shaded area, this shows the market expectation. and the yellow dotted line shows the Fed's expectation. Now in that blue shaded area where it drops down to the lowest level, that was at the beginning of this year, and it basically showed that investors, or the market generally, expected the Federal Reserve to cut interest rates 6 times, or 6 quarter point increases, down to 3.83% by the end of 2024. And at the same time, the Federal Reserve expected only 3 quarter point interest rate reductions, so down to just 4.6%. So there was a big difference between what the market expected and what the Federal Reserve expected for interest rates. Today, what you can see is that gap has closed. So it turns out the market has effectively capitulated and has now agreed with the Federal Reserve that there will only be 3 interest rate reductions this year. And one reason that investors expect fewer interest rate cuts is because inflation and progress on reducing inflation has been a little bit harder as of late than it was for the prior, 1 to 2 years. So this chart on the left shows the year-over-year change in the consumer price index. And of course, that measures the change in a broad basket of consumer goods. So this chart shows the spike in inflation up to just over 9% that we saw during 2021 and early 2022, followed by a period of rapidly falling inflation. But just recently, and you can see this in the yellow box on this chart, we've seen a bit of a slowing in the reduction of inflation. So the chart on the right, this tracks gasoline prices. And this is really a key to why we've seen a slowing in the reduction of inflation. So if gas prices continue to increase, this could complicate the Federal Reserve's attempts to reduce inflation at a rate that the markets want and that the Federal Reserve wants. So another thing that calls into question the need for interest rate cuts is the debate about whether financial conditions are actually restrictive. What I mean by that is, has the Federal Reserve increased interest rates to a level that is constraining economic activity? Now, one place that we can look for an example of where economic activity is still quite robust is in housing construction activity. So this chart shows housing construction activity at various levels. So we can look at those not started in gray. We can look at housing under construction in light blue, and completed houses in dark blue. Now, the level that you can see where we are in 2024 is quite high, right? We're at levels that we haven't seen since just before the 2008 financial crisis. Now, one reason why housing construction activity is so robust, in spite of having mortgage interest rates that are at 15-year highs of around 7%, is because we all refinanced our homes at very, very low interest rates. We're not willing to sell, so there's a lack of inventory. But the other reason, and probably a more important reason, is that you can see this big decline in housing construction activity after the 2008 financial crisis in this chart. And it took a long time for that activity to recover, right? At the same time, demand for housing continued. So we really are facing a supply constraint at this point. There's not the supply that's needed for the demand. And that's supporting housing prices. And it really does, it creates a problem for the Fed and upward pressure on inflation. Now, the other thing that is important to look at is consumer spending. Now, consumer spending is 70% of the US economy, so a very important thing for us to track. One way we can get a bead on consumer spending is to look at its inverse, to look at consumer saving. And that's what this chart shows. So it shows savings as a percentage of disposable income. So we can see that during the pandemic, so at the beginning or during 2020, we saw those savings rates go sky high when we were getting checks from the government and not spending as much. And then we can see them fall precipitously, and they're declining today. Now, what this is an indication of is that consumers are willing to spend. It's an indication that the labor market is tight, right? If you want a job, you can get a job. The economy is strong, wages are growing, stocks are doing well, so consumers are spending. And this is another area where we're already seeing robust activity. And do we need to cut interest rates? And this may exacerbate this consumer savings trend and complicate the job of the Fed to contain inflation. What does all this mean for investing? I think it's really important at this moment, especially when we see the stock market at record highs, to take a deep breath and remember that we need to stay disciplined. Right? There's a temptation when we see the market at record highs to want to get out of the market. It's the idea that the markets are very, very high. But we have to remember that we see record highs all the time. That's why the stock market has grown over time. Now, a few data points here. When you achieve a record high, on average, what is the subsequent one-year return after that record high? Over 13%. Well, what about the average return to the stock market 3 years after a record high? Over 10%. And 5 years after a record high? Again, over 10%. The moral of this story is that we need to stay diversified, we need to stay disciplined. Thanks for watching today. If any of you have questions about anything we said today or anything else, please reach out to a member of your team. We're always happy to help.